Well, he is known as the father of the index fund, and while index funds may seem pretty boring to investors chasing yield, they probably saved you a lot of money in the last couple of years. John Bogle, founder of Vanguard, joins us now from Pennsylvania. Thanks for being here. Appreciate it.
It's always good to be with you.
You have worked at this for, some 6 decades, and you're still making the case for passively managed index funds, even in today's market. I mean, why is that the best bet?
It's always the best bet. I don't know why people can't figure that out. It's, basically it's about simple mathematics, actually what I call, after Justice Brandeis, the relentless rules of humble arithmetic. And it's easy to understand. Let's assume the stock market gives us a 7% return. That's what we all divide up inevitably. No way around that. And the financial system takes 2.5% out of that return. So the average investor gets a 4.5% return in a 7% market. The index fund gives you not quite 7%, but almost the entire amount of the market return because it takes all the costs out of the system. So the index fund is and must be and will be the gold standard forever, just because of the math.
Investors right now around the world, and especially here in the United States, are making their own equations that flocking to commodities, whether it's gold or what have you, or emerging markets, are their best bet right now. You've been advising people not to invest internationally. You said, look, I think you're going to get the same returns in a 10-year period, whether you put your money in emerging markets or in the U.S. market. Make that case for us, because there are a lot of folks out there that disagree with that.
Okay, sure there are, and I'm rarely in the majority opinion. I try and think for myself where I can. Let me say this: the markets are not stupid. They may not be entirely efficient, but when you look at emerging markets or the developed markets abroad and the U.S. markets, everybody knows that the emerging markets are growing faster, that the developed markets have some problems that are actually greater than the U.S. markets, and the U.S. has this tremendous problem, but that's all in the price. The stock market, wherever it is in the world, is a great arbitrageur between the present and the future. It takes this into account. So I think the best bet is that they'll all do the same. And I also think there are a lot of risks that we don't take into account in the developed markets. Some of these countries are very unstable. If an investor wants to take that kind of a risk, maybe 20% in international, 10% of that, or 10% in emerging markets and 10% in developed markets, I wouldn't tell them not to do that because they're not going to hurt themselves very much.
This week, the all-important Fed decision, they'll likely keep rates close to zero. We'll likely see QE2, the Fed coming in, buying up assets. How should mutual fund investors incorporate that into their investing decisions? What does it mean for them specifically?
Well, I think it's very hard to judge the implications of what the Fed is about to do, and even what they've done already. What we've done to get out of this ghastly recession we've been in. Maybe working better than people think it is, or maybe working worse. I don't think we should try and outguess ourselves or the markets. So I'd say the implications are not great. I believe the best secret for long-term success in investing is setting a strategy, an asset allocation strategy in particular, how much in bonds and how much in stocks, and with more bonds as the years roll on, as they have for me, and more stocks when you start investing, maybe all stocks when you start investing in your first 401k plan or IRA. And don't change that plan on the basis of these things that go on in the markets each day. The Fed's report on a couple of days hence is going to be not even a footnote in history. It may roil the markets for a minute or two or an hour or two or a week or two. But it's some noise out there that we ought to be really trying to ignore.